Good afternoon, everyone. Wherever you are watching this in the world, I hope you are healthy and safe. Thank you so much for joining the Atlantic Council for this timely discussion on the impact of the oil market crash on major Latin American producers, particularly Brazil and Mexico. My name is Randy Bell. I'm the director of the Global Energy Center at the Atlantic Council. And along with our Adrian Arst Latin America Center, we're delighted to host this prominent expert panel to break down the impact of the oil price collapse for these two major producers. My colleague Jason Marksack and I will co-moderate the panel. Now, usually the Atlantic Council doesn't allow us in the same room together because of the amount of trouble we cause. We will see how we do well when we're in the same virtual room, but I hope that this works out. We're going to begin by introducing the speakers today, and then we'll go into some questions. And if you have any questions while we're speaking, please be sure to use the Q&A function or the chat function, and we will get to those. We'll try to get to as many questions as we can as we go through the conversation. If things are relevant, we'll call them. So today we have a really fantastic group of panelists. First, Sarah Emerson, Managing Principal at ESAI Energy, research and consulting firm on petroleum and alternative fuel markets. She's an expert witness in energy sector arbitration and litigation, an advisor to national governments on energy sector issues, and was a reader commentator for the IPCC Fourth Assessment Report. Next, we have David Goldwyn, president of Goldwyn Global Strategies and chairman of Atlantic Council Global Energy Center's Energy Advisory Group. That's a lot of words. He's also a member of the U.S. National Petroleum Council and the Council on Foreign Relations. David served as the U.S. Department of State's Special Envoy and Coordinator for International Affairs from 2009 to 2011, and Assistant Secretary of Energy for International Affairs from 1999 to 2001. Most importantly, David is the author of numerous Atlantic Council reports, including our recently launched A New Energy Strategy for the Western Hemisphere, which was commissioned by the U.S. Department of Energy to inform their strategy in the region and is very relevant for this conversation today. Jason, over to you.
Thanks, Randy. And for those who haven't read the New Energy Strategy for the Western Hemisphere, now that you have some time at home, it's a great time to do so. We're also joined by Jorge Camargo, who's a vice president of the Brazilian Center for International Relations, known as SEBRE. He's also a member of the board at the Brazilian Institute of Petroleum, Gas, and Biofuels. He's also a member of the board at Prima, which is a private Brazilian company engaged in infrastructure and logistics. For more than 7 years, Jorge has also worked as a senior advisor at McKinsey, and he's also served in numerous positions at different energy and infrastructure companies. And Jorge, it's great to have you here, and also it's really great once again to partner with SEBRE, such a well-respected Brazilian institution that we at the Adrian Arst Latin America Center and the Atlantic Council overall always find any opportunity to partner with SEBRE. So very great to be doing this with you. SEBRE also just recently published its dossier special edition, including David Goldwyn's article on the U.S. 2020 election and what's at stake for energy. Finally, our speakers are running up by Francisco Monaldi. Francisco is a fellow in the Latin American Energy Policy and also interim director of the Latin America Initiative at Rice University's Baker Institute. Like SEBRE, Francisco, always great to partner with Rice and the Baker Institute. He's also a visiting professor at the Tecnológico de Monterrey's School of Government in Mexico. Francisco also is a founding director and professor at IESA, the Institute of Superior Administrative Studies in Venezuela and their Center for Energy and the Environment. He's a leading scholar on politics, economics, and the oil industry and oil wealth management across the region. Similar to David, he's also authored Atlantic Council publications, including one on Venezuela's oil sector. Francisco, that actually, I think the U.S. audience all got to know it when it appeared on John Oliver's show when that came out a couple of years ago. I want to remind everyone to please feel free to tweet about all the interesting findings you're getting as part of this panel, or ask questions using the hashtag ACEnergy. And we will include those conversations as part of the panel. Also, if you're joining us via the Zoom video feature, there's a chat box on the lower right part of your screen, and you can submit questions directly to us via the chat function. And we'll try to pick up your questions over the course of the conversation, whether via Twitter or whether through the chat function as well. What we're going to do is we're going to start off and looking first at the global context of the price crash, and then we'll look specifically at implications for the energy sector in Brazil and Mexico before turning to larger economic implications. And we always like to try to be somewhat glass half full, so then looking at what kind of opportunities that could bring. Randy and I will ping pong off each other on these questions. Sarah, let's start with you. Oil prices have plunged due to massive supply glut and also plummeting demand caused by the coronavirus outbreak. You also recently, Sarah, published a one-year outlook. If you could start off by explaining, are we in a new normal for oil prices? And also, how long can we expect the current prices, sub 20s, to actually continue moving forward?
Okay, thank you, Jason. We are definitely in a new market, but I wouldn't necessarily call it a new normal. The increase in supply and destruction of demand that has led to the surplus that we're now facing is really unprecedented. I've been doing this for 30 years. I've never seen anything quite like this. And we are in the beginning. March was sort of the beginning of building some significant inventory because we're producing much more than we're consuming. So as you know, prices have come down. In terms of whether that's going to last, I think you have to take into account that prices are actually a little bit lower than what the futures market suggests. Prices in Permian are closer to $11. Prices in Houston are more like $14, and dated Brent is down, probably 16, 17 now. So these are prices that are already in the teens or lower. And I just don't think that's a sustainable price. Eventually, oil producers will either voluntarily or involuntarily cut production. They'll have to. There's not enough storage to continue to build these kinds of inventories month after month.
And what does that look like? How much time before producers decide to cut production? What's your estimate?
Well, I think there's already some signals. I mean, obviously these price signals are pretty strong in that the price is so low. I think what's happening now is we're beginning to build the inventory, and as inventories accumulate, and I think they've done a pretty good job in March, but I think April's probably going to be the biggest period of accumulation. As that happens, I think the spot prices they're under even more pressure. And you begin to have, we've already heard force majeure in a number of refiners who've said, I just can't take any more crude. I'm not going to take any more. As that happens, the producers either stock it up themselves or they begin to cut back. And I think we're not quite to the point where they're ready to do that. But I would think by the end of April, we may be looking at a very, very different market. And certainly by the end of May, we would be, if some kind of action hasn't already been taken.
Thanks. And we have a couple of questions related to this, but one is more your crystal ball. How long do you think the price will remain this low?
How long?
Yeah.
Well, you can do a lot of sort of forecasting and research and studying and statistical analysis to sort of figure this out. But, none of us really know for sure, right? But I do know that there is, at some point, there's just too much oil. Someone is going to have to cut back. And so I believe when those stories begin to come out, I think that begins to put a floor under the price, and you maybe actually see it creep back up. In our numbers, we think probably by the end of April, we're going to begin to hear some more stories about companies preparing to cut back or beginning to cut back. I would think certainly through May, we'll hear more of that. And I believe once you start hearing those stories, I even think we could have a voluntary cut. So I think we start with some involuntary cuts, predominantly in maybe non-OPEC countries. And then maybe that pushes us towards a more voluntary cut, maybe in that June, July, well, let's say May, June period. And I think once that happens, you begin to floor into the prices and you begin to come back up a little bit. So I think we have another month or two of some pretty nasty pricing.
Got it. So pivoting onto Latin America, Francisco, even though this supply gut started really as a price war between Saudi Arabia and Russia on the one hand, and then dramatic demand decline on the other, not really coming from Latin America yet. What does this mean for oil producers in Latin America broadly?
So Latin America produces close to 8 million barrels of oil, and the majority of that production, of course, is in Brazil and Mexico, which are the two largest producers that we're going to discuss today. But those are not the countries that will be most affected, because other countries have a much more significant reliance on oil. Of course, Venezuela, that we might discuss later, it's going to be in big trouble, because already it was, and of course it has on top of that sanctions. You have Ecuador, which is also a country heavily dependent on oil, and was already under an IMF program and with a lot of significant difficulties. And Colombia, which is another country with the majority of exports are oil, and even though it's in a much better fiscal position, it's a country with high oil costs. And so if the previous decline in 2016 is an example, we will see some significant cuts in production in Colombia. In the case of Argentina, the cost of the conventional production there is not, they can continue to produce, but Vaca Muerta, all the shale development that is sort of the future of Argentina, and in which Alberto Fernandez, the president, counted as an engine of growth, it's not going to work with this price environment. So it's a very tough environment for the region. This is a region in which significant dependence on commodities in general, but oil in these countries. Guyana, a new producer, also. They just had their first production, and now this collapse. It's also not great news for that small country.
And Francisco, just a quick follow-up. Out of those, Colombia, Ecuador, Argentina, you mentioned Guyana, which all face a number of challenges, more prominent than what we're going to talk about today with regard to Brazil and Mexico, the largest producers. Which countries are best poised to withstand the crisis that we're in right now?
Well, I think Colombia, it's in better shape because the fiscal situation was better managed in the past. But they do face a tough time, as I said, because of the high cost production that they have, particularly transportation costs are significant. The others, I think, are in deep trouble, all of them, right? Yeah. And we will move then into the big players, in which, of course, Pemex is a big issue, but the national oil companies of these other smaller producers are going to be in really bad shape.
David, pivoting to you here on this global context and looking specifically at Latin America here. Brazil and Mexico have not been part of OPEC production agreements, but of course have benefited from them. And this time, both Brazil and Mexico are suffering from an OPEC generated crisis, frankly. Do you see looking across the region, do you see that there could be looking ahead, certain winners and losers across Latin America as a result of OPEC production agreements?
I think there will, and I think there will be a reordering. Globally, I think when demand comes back, you're going to see that the countries that have low above ground risk and high rates of return, or better competitive rates of return, are going to be the most desirable countries. So in this context, Mexico is a tough play with all of the uncertainty about whether they want foreign investment, whether there'll be auctions, what the rules are. In the risk profile, they go to the bottom of the stack. I think the countries that either have very large plays and therefore low unit costs, like Brazil and like Guyana, will do well because the rates of return are more competitive. So I think that is going to change. And on globally, you're going to be looking at smaller amounts of investment. And I think what's important to keep in mind is exploration is relatively cheap. You drill a few wells and you define the field. Production is expensive. Exploration is hundreds of millions. Production is billions. So the question is, who goes to the next level? I think Brazil is up there. I think Colombia always has the ability to adapt. Ecuador, if they don't go bankrupt, can be competitive. But the real question here is, how will these countries adapt to this new reality, and will they make themselves competitive or not?
Got it. So Before we do a deep dive into Brazil and Mexico, round robin for all four of you, a question from the audience. Does it make sense for either Brazil or Mexico to join OPEC? We'll start with Francisco.
No.
David.
I think it's going to be in everybody's interest to look at OPEC plus. And keep in mind, in 1998, Mexico collaborated with Venezuela and with Saudi Arabia to lead the cutback. And as soon as the prices rose, they bailed out. So I think you are actually, whether they should join OPEC, I would say no. Whether they will collaborate in production cuts, I think the answer may be yes.
Sarah.
I agree they should not join. But I also agree with David that certainly in this year's crisis, it will behoove them to work with OPEC this year.
Jorge.
No, I don't think it's a good idea to join OPEC. In fact, I think OPEC is a moribund type of organization. I think we may have some sort of organizing body or in the future, which we don't know exactly how it's going to be. But certainly the OPEC, as we know it, I don't think is a good idea for Brazil. I don't think, although some people defend that proposition, Brazil, but I don't think this is going to prevail.
Got it. Thank you. Okay. So Jorge, I'm going to talk a little bit about Brazil right now. So Brazil and Petrobras were undergoing a major transformation as this crisis took hold. Over the last couple of years, there have been significant interest in Brazil's oil sector, whether that be the potential of recent divestment announcements by Petrobras. So they seem to be in relatively good standing financially. How prepared is Petrobras to stand off this oil price shock? And what does the price crash mean for current and future pre-salt wells?
Yes. Well, of course, this market crash has a worldwide impact. And Brazil and Petrobras, of course, are no exception. Just to give you one illustration, the market capitalization of Petrobras plunged 70% over the last weeks, from $100 billion to just $30 billion. That's the size of the collapse. But having said that, Brazil and Petrobras, everybody will suffer. I believe that there are reasons that Brazil, as Dave said and Francisco as well, has some elements that differentiates itself from other producing countries, and in a positive way. And basically, it's resilience to low oil price, and for just 2 or 3 reasons. One is that, as you know, Brazil is essentially an offshore play, a deep water offshore play. The pre-salt province today represents something like 70% of the Brazilian production, and this is dominated by Petrobras and the big IOC. So because it's a capex intensive, it's technology intensive, and these big guys, and they have big balance sheets, so they are more resilient to downturns than smaller and medium companies, and they really dominate the market here. That gives one element of resilience to Brazil. The second one is the pre-salt, is the main play, has an extraordinary productivity. There is the pre-salt reservoirs. The typical pre-salt well produce something like 20,000 barrels a day. Some of them produce 50,000 barrels a day just in one well. And as a result, they have a very robust economics. Most of the pre-salt projects, they have an investment break-even in the order of $25 per barrel and lifting costs of $6, $7 per barrel. So the projects are economically robust. It doesn't mean that the investment is going to happen. The main obstacle to the investments, and the investments are going to diminish, will be more the cash flow of the companies, especially Petrobras, which, as you said, improved a lot in the last 2 years, but still has vulnerable finance. But the projects and the operators, they are more resilient. And of course, there is a third element, which is the markets. Now, the Brazilian market is a big market. And so it's there. It's suffering, it's declining, but it's there. And will continue to be there. And also, Brazil is a big exporter. We export something like 1 million barrels a day to Asia and China, which also I think it's on their interest to have something like Brazil as one source of supply, to diversify, and is a reliable source of supply. So these three elements, the strength of the operators, the economic robustness of the pre-salt play, and the size of the markets, I think makes Brazil in a better way than some other companies in Latin America or in the world.
Jorge, I mean, your takeaway is that you think Brazil's pretty resilient to these price shocks, given those factors, and will be so for some time. Would you say again? I got to close. Brazil will be pretty resilient. That it can withstand these price shocks for some time, given those factors.
Yes, it can stand. The main impact, I believe, will be on the investment curve. Brazil has something like $300 billion of investments that are, let's say, sound investments for the next 10 to 15 years, and that would make the curve of production to almost double, possibly. This is going to be flattened. Investments are going to come down. For example, Petrobras announced just a few days ago that their investment plan for this year, which was $12 billion, are going to be reduced to $8 billion. So it's a $30 billion, is a 30% reduction, which is important. So we are going to have an impact. Of course, the curve will be more flattened, but I think we are going to survive.
And just a quick follow-up question for you, Jorge, before going to you, Francisco, to ask about Mexico. But a question here from Mariana Panaga related to what we're just discussing, which is whether you're expecting Petrobras to cut back production at shallow water and onshore fields where you have lifting costs that are $19 per barrel last year.
Actually, they did, because Petrobras is not only pre-salt. They have shallow water fields. They have onshore fields that really are not sustainable, are burning cash in this low oil price. So they have, for the first time that I remember, they cut 100,000 barrels a day already this month. So 80% of this is related to reduce the production, because of course they also don't have outlets for all this oil that's being produced, and 20% due to costs. But 100,000 barrels a day has been already reduced, and only for March, but I believe this is going to go forward for a while until price and demand recovers.
So Francisco, a slightly different story in Mexico. When we look at Pemex, we look at Mexico's oil sector. We've seen declining production and also pretty sizable debt that's been stalling Pemex over the last few years. How do you see this external shock constraining or further constraining Mexico's energy sector? And specifically, what do you see as the most immediate implications for Pemex itself?
Sure. So Mexico is not, as it used to be, a country heavily dependent on oil anymore. It's barely a net exporter at this point. It imports almost as much as it exports, and in terms of dollars, it's actually, the balance is actually negative. So it's a different kind of country. But the national oil company, as you point out, Pemex, is in deep trouble. They have about $115 billion in debt. It's the more indebted oil company in the world. And they have declining production. They barely stabilized it last year. And they lost $18 billion when the prices were where they were last year, right? So with this new scenario, it's really, really scary for Pemex, because, the Maya was at $9 yesterday. Even though I don't believe that this is sustainable, as Sarah mentioned before, we expect at some point this year that we will have higher prices. But this is, at this point, a lot of Mexico's production is below cost if you include taxes, and some of it is, the price is so low that some of it is even, the lifting costs are higher than the price. So for Pemex, this is a very difficult situation. The government injected a ton of money last year, about $15 billion. They have $6 billion in debt payments this year. And they already were downgraded by Fitch. I think they might be downgraded by other of the rating agencies. So they are in very difficult situation.
That goes to a question from the audience. When do you think the other rating agencies will downgrade Pemex? What's that timeline?
I think it's going to be pretty soon, to tell you the truth, because the combination of things that is happening and the lack of clear reaction, by the government. I think everything points towards. It used to be that because the rating agencies believed that the government of Mexico, which was in a relatively reasonably good fiscal position, was going to back Pemex in any scenario, that that they thought that they might not need to downgrade it. But I think now it's inevitable, and it's going to be relatively soon.
Got it. Okay, David, you had a two-finger on the Brazil questions, so I'll go to that, and then I have another question for you on Mexico and
So, yeah, I was just going to pick up two important points that Jorge made. It's Brazil's framework and its flexibility that enables it to be resilient. Your question was about Petrobras, but Brazil is a country, because they no longer require Petrobras to be the operator of every field, because they have had auctions and companies have drilling commitments, they have production plans, they have investment commitments that are going to last for a while. When demand recovers, Brazil's at the top of the stack, and that resilience comes from the diversity of investors. Mexico, by contrast, because they've paused the auctions, there are two risks. One is, if you rely on Pemex to be the shallow water operator, it's high cost and they may not have the money. And the question for the people who are doing exploration is, do they stay or do they go? They might find oil, but they might say, it's going to be too expensive and too hard to operate here. And so right now, unless it adapts, and it has the ability to adapt, Mexico has undermined its own resilience by pausing these auctions and by sending these mixed signals to investors about whether it wants pipelines, whether it wants upstream, whether it wants investment at all. And so Mexico is going to have to adjust to that, or they're going to suffer from what might be a significant fall off and greater than they might see otherwise.
Got it. So on Mexico, question, what would potential shut-ins in U.S. shale mean for Mexico's gas imports?
Yeah, the gas outlook looks pretty grim. I think the projection is that natural gas for power generation is projected to be down about 8%. I think they're looking at, because of the GDP loss, the economy contracting, general gas demand being down about 400 million cubic feet a day, coming up soon, and gasoline. You asked about natural gas, but gasoline is down as well. So I think the outlook is pretty contractionary for natural gas demand. But this is another case where, if this was a time when the government decided to intervene, get the rest of the pipelines built, allow the rest of the country to have access to gas, the shape of that curve is flattening, but it might pick up again. But again, we need the signal from the Mexican government that they're actually going to want this natural gas and want it to promote development. The biggest risk to natural gas demand overall, looking out 6 months, a year and a half, is the general state of Mexico's economy. And right now, as we were talking about with the credit rating downgrades and looking at almost 2% negative growth, the outlook is not good.
And a quick follow-up question to David, you or Francisco on Mexico, and then we'll turn to you, Sarah, for looking kind of more broadly globally again. But do you see this, where the current state of allowing, this is actually a question that came in from David Horgan over the Q&A on the Zoom feature. Do you see the lower oil prices potentially pushing AMLO to accept better fiscal terms for foreign investors, or do you see President Lopez Obrador remaining pretty steadfast even with the lower prices and the demand reductions?
Well, I'll defer to Francisco on whether they will, as opposed to whether they should. But I think two important points. One is the fiscal terms, in a sense, are set by the reform. So the president doesn't have to adjust the terms. There's a flexible royalty that's very fair to Mexico when prices are low and fair when it's high. The question is, will they resume auctions, and will they provide enough certainty that the people who are investing now continue to invest? And so far, there has been no indication that the Mexican government is ready to change tack. They've talked about a new infrastructure package, probably off the table now. So everyone's waiting for a signal, but we haven't seen it yet. But this would be a great time for the president to listen to some more voices and take another look at how to adapt.
I agree with David on that. I am a little bit concerned that some of the biddings that happen, even though the royalty adjusts with the price of oil. I mean, I think at these price levels, a lot of the biddings that occur in Mexico don't look attractive at all. So that might be a problem, right? But in terms of, I think one of the big problems is Pemex itself, that it's overtaxed. They try to reduce taxes on Pemex, but they rely so much on Pemex that they cannot do too much on that. In terms of the future, I do think that López Obrador will eventually have to become more pragmatic here. It is clear that he's. I mean, after the downgrades of Pemex and the Mexican sovereign, and after the fiscal trouble that he will be facing, I think he will realize that he needs to change course on the oil industry, build a much smaller refinery than he's planning to, and reopen the sector. Maybe he does it through JVs, because some people in his administration prefer Pemex to do JVs. That, of course, puts constraints because Pemex does not have the capital, but that will be my guess.
Thanks, Francisco. We lost you for a moment there, but we'll transition to Sarah. Sarah, when you look at this major external shock and prices failing to recover past $30 per barrel for a long period, what could this mean for the global market share? And a second part to that question, which came in over the Q&A, which is, when you actually see prices recover, when do you think prices could actually recover to?
Ooh, that's a tough question. I mean, we're right in the belly of the whale right now, so the market's very, very oversupplied. But let's assume that there's some kind of, as I said before, voluntary or involuntary production decline around the world. I think you can get back into the 30s for sure. But I think we may actually have a bit of a hangover in 2021. Maybe we can get back closer to 40 for Brent. Again, it depends on the will of the producers to cut back and the pace of the recovery and demand. We're really in terra incognita, because we have this big event that's caused this decline in price, but we also have an event that will come to an end at some point. We will recover from COVID-19 and demand will begin to pick up again, and it could actually bounce back quite aggressively. So getting back to the high 30s to high 40s is not out of the question at all in early 2021. So sorry, the second half was market share of?
What are the implications for global market share?
For Brazil and Mexico?
Yeah.
Well, I mean, I kind of echo everything that the other three speakers have been saying. I mean, Brazil seems to be in a very good position, maybe not necessarily to grow capacity at the moment, but certainly to sustain capacity. Mexico, it's heavily indebted and has production's declined for years. Without foreign investment, I'm not sure just how much more you can do in Mexico. So I think I think the two countries are definitely standing on different feet in terms of how they can handle this sort of bid for market share.
I want to combine two questions from the audience and pose them to all of you. And they're essentially about how in oil price downturns, oil companies or service companies tend to become much more efficient. At least that's what we saw last time. Do you see that possibility in Brazil and Mexico? And particularly in Mexico, where some of the highest producing fields are some of the most expensive. Do you see also the government allowing some efficiencies that might not that might be imposed from the outside into the production? So let's start with Francisco on that.
Well, you know, in the previous administration, they significantly reduced costs in Pemex. One thing that they didn't, tell too much, but it happened is that they dramatically reduced the number of employees in the company. But having said that, it's going to be really tough for Pemex to significantly do additional cost cutting unless they change the framework that López Obrador is providing, because he is planning to add barrels in fields that are relatively costly instead of opening up the sector as we said. He's planning to build a very bad decision, a costly refinery. So all those things are pointing in the wrong direction in terms of cost. But they have announced already some cuts in cost-cutting measures, but they are, not significant.
David, what are your thoughts on this?
Well, the big economies in the last downturn came from standardization of equipment, from doing what they call tiebacks to existing wells rather than drilling entire new ones, and from optimization in shale. So I think that wheel has been invented, but I don't think it can be invented again. The other thing that you saw, and this is just what Francisco alluded to, is companies like state-owned enterprises in particular started to get out of businesses that they didn't belong being in. Either they sold off non-producing assets like part of their midstream, or sold off refineries so they could generate cash for exploration. So Pemex was on that track until the reform, and now it's stopped. And frankly, it wasn't doing that well to begin with. They still own so many companies that have nothing to do with the business they're in. Petrobras, on the other hand, is in the middle of that kind of privatization. And my guess is it will probably accelerate. So they're better positioned, but I don't think there's as much room as there is for efficiency gains this time around, because they really just got through a major round the last time. And politically, it's much harder for the state-owned enterprises to make those efficiencies, particularly when it comes to personnel, than it is for private companies.
No, I fully agree with David. And I want to come back one point he made previously, that if Petrobras and Brazil is in the better situation now, is the reason, one of the main reasons, that we did the homework 2 years ago, opening the country for more private investments, making auctions, reducing local content. And Petrobras management, Petrobras was in shambles financially and everywhere. And now, after 2 years, they are in very much better shape now, and better prepared for these difficult times. But I agree that this is going to have an impact on costs. And the president of Petrobras, Castelo Branco, has just made an announcement a few days ago that he's preparing, his management is preparing Petrobras to be able to survive at $25 a barrel. So previously, they were prepared to survive at $40 a barrel, but now they are lowering the bar so that the company can be financially sustainable at 25. That means, of course, a lot of more cost reductions and innovations and of course directing the investments to the better projects. That means divestments too. So in that sense, I think that's we are going to see more of this, what have been before, but more intensive now, both the cost reductions and divestments.
And Sarah, just to finish this round up.
Yeah, I think when you were talking about the previous price decline and the efficiency gains, I think we were talking implicitly about shale. And shale, it's a private industry with tiers of capital. And the folks that had the most expensive capital had to change their behavior and change the way in which they ran their companies and how they drilled. And they did a great job in a way of optimizing and improving their cost structure and productivity. So I don't see either Mexico or Petrobras sort of in that camp, so to speak. Although I do think when you have a price decline that is this global and this powerful, maybe this is a wake-up call for the national companies.
Jorge, before diving into, we're going to dive a little bit into the larger economic implications of the price shock. But there's a specific question for you from Lisa Vasidi. When will Brazil hold its next bid round?
Well, there were some 2 or 3 bid rounds planned for this year and the next. I believe that there is no announcement yet, right? I believe this is going to have some delays. Now today, or just this week, the government announced the delays on the electrical project auctions that they're going. It is supposed to happen in end of April. So the government is trying to, especially due to the low oil price and all the situation, that they're waiting for the environment to be more clear. Huh? So it's not announced, but my feeling is that there are going to be delays, but they're going to happen going forward.
And Jorge, we're looking at President Bolsonaro has had a, let's say he's been very concerned about the economic effects of coronavirus and the economic effects of imposing a general quarantine in Brazil, as has been imposed in a number of other countries across Latin America, frankly, and states across the United States and Europe as well. What do you see insofar as the economic slowdown that is occurring, will continue to occur? What do you see as the implications of that in practice for the energy sector specifically in Brazil?
No, you're right. President Bolsonaro is kind of isolate himself politically because he's very much concerned on the economics, and rightly so. But sometimes he conveys a message that he's not so concerned about the quarantine and things like that. But the economics concerns are really very, very important, and we are going to have a painful recession this year. This is contracted already. The impact on the energy sector, or the energy sector impact on the economy, I don't think it will be that, because as Francisco said about Mexico, Brazil also is a much more diversified country now compared to other oil-producing countries. Our fiscal revenue that comes from the oil and gas are around 5% of the total, 8% of the export. So it is part of the big picture, but it's not such a relevant part, except, as I said before, to the Rio de Janeiro state. But overall, we are still seeing what's going to be impact, the result of the government's measures to try to support small business. And but the oil and gas, or the energy sector, seems going to go by side. One of the main concerns that I have, in the energy side, is on the ethanol. The ethanol business in Brazil is very big, and ethanol also has their price linked to the oil, and they have to be 70% of the price, because of that's the caloric equivalence, and the ethanol cannot survive on that current price. And as a result, the next harvest is coming, and some of the distribution companies are claiming force majeure on their contracts to buy the ethanol. There are 1 million jobs on that depends on the ethanol. So this probably is the most relevant impact on the energy industry, is how we are going to solve the ethanol issue, or by some tax on the petroleum derivatives, or some people are talking about some import tax also on gasoline and diesel, just to sustain the price of gasoline above certain level that could, let's say, make the ethanol viable. So that's more or less the picture we have now. But it's still very, very foggy, the way forward.
Yeah, very foggy, but as you say, very concerning, especially for the state of Rio de Janeiro, right, which already has budgetary challenges. You add on top of that the shock for the energy sector, and when you look specifically at the whole value chain across Rio and other parts of Brazil, and what the implications are of small and medium-sized businesses.
Yeah, and probably the most impact will be right now on the supply chain. I think, as I said, operators, they are strong. They can survive. But the supply chain, I think they were not in good shape before this crisis. But they now, with all this cost-cutting exercise that all the operators are doing, so this is going to be like kind of a bloodbath on the supply chain.
Francisco, will you see any of these major economic impacts in Mexico? Will we have a labor market problem as well?
I think the impact of the oil sector downturn in Mexico, because of the nature of the Mexican economy today, that it's much more diversified, and as I said, it's almost a net importer of oil, and in terms of fiscal revenues, it represents about 12% of fiscal revenues. But because of the issue with the national company, the one channel that will bring problems to the economy is the downgrading of Pemex, that, as I said, it's already happening and it's going to continue to happen, and of the sovereign. But the other issue, I think, that which is much bigger is the issue of the recession in both the U.S. and in Mexico, produced by the coronavirus, unrelated to oil. That I do think that it will be a really, really big problem for Mexico. In terms of the oil sector, you will have, maybe some reduction in the number of employment in the oil sector, but that's a small, even with the big number of more than 100,000 employees that Pemex has, it's a tiny, part of the job market of Mexico. But it's going to be much worse because of the effect of the coronavirus on the rest of the economy. That's what I think will really affect first the economy and then the politics of Mexico in the next year and a half.
Very concerning, right, Francisco? Because when the U.S. sneezes, Mexico catches a cold, and the U.S. is certainly sneezing right now,
and Mexico was already with immunocompromised, right? I mean, Mexico was in difficult shape. They didn't grow when the U.S. was growing, which is unprecedented in many years. And now we will have a combination of a recession in the U.S. and the Mexican economy also in big trouble. So I think it's going to be a really tough couple of years for Mexico.
Sarah, picking up, we had a question for Jorge on supply chains, and Jorge was mentioning his concerns about the implications for small and medium-sized businesses in Brazil as a result of the current crisis in the energy industry and lower prices. What do you see from a broader perspective, this new scenario? What could it potentially mean for small and medium-sized producers in both Mexico and in Brazil? And could the way in which the market is moving, could that potentially lead to greater corporate consolidation and maybe a pushing out of some of the smaller businesses that have traditionally played more of a role in the supply chain?
So, I mean, I think it is the same as in any other country, really. If you have low oil prices, the companies that have a stronger balance sheet or have lower cost of capital or have access to capital are going to have a little bit more power. I don't know enough about the small and medium players in these two countries to know who those might be. But certainly in this low price environment, unless they've got great assets, so they got some of the core assets in either country, they're most likely either not going to be able to grow or they're going to become a takeover target, especially in a country where there is foreign investment, which I know that's not the slam dunk in either country right now. So I think it's tough to be small when you're in a low price environment, even in a country where you're competing with a national company that perhaps is inefficient. Can I just make one other comment about the crude oil market for these two countries? That just, as I was listening to my colleagues speak, and that's just one other benefit that Brazil has is it has just a better crude oil to sell. It's selling a lot of now medium sweets into China, and that's a great market to be in. It's a growth market. It's a high quality. They're high quality crudes, and that's going to stand them in good stead going forward. Mexico continues to be in this symbiotic relationship with the United States, selling heavy sour crude to the U.S. refiners. And to the degree that U.S. refiners at some point will have to cut runs, not because of today's crisis, but going forward because of demand, it's just not as powerful a relationship as selling the kind of crude that Brazil is selling into China.
Broadening a little bit. And again, I think this may be another good round robin question for each of you. We've talked about how this crisis will impact Mexico and Venezuela. What other countries, and let's maybe, I said Mexico and Brazil, I was going to say let's exclude Venezuela from this question. What other countries in Latin America will be most impacted by this oil price crash? And we'll start with Francisco.
As I said before, Ecuador is going to be in deep trouble. This is a country that heavily depends on oil export. It is dollarized, and therefore external shocks affect them more. I mean, they have less capacity to manage external shocks because they cannot devalue their currency. And so they are already in an IMF program, and the president, who was from the party of Rafael Correa, turned against him and is doing austerity measures. I think it's going to be a very difficult time in Ecuador. It's going to go back to being a very ungovernable country. Colombia is also, I think, a country that will suffer for this, but much less than Ecuador.
David.
I'd add Argentina to the list. I agree completely with Francisco. Ecuador is at a risk of default. Colombia, I always have faith in the Colombians to adapt their framework to be competitive. They punched above their weight for decades, so I think they'll do it. They'll do it again. But Argentina, a low price for gas. The big challenge in the Vaca Muerta is infrastructure. It's getting the gas out. The market was going to be to Brazil and to other neighbors, as well as for domestic consumption. And Argentina, in classic style, is worrying about should they have a floor price, should they have a ceiling price. They don't want imports from other countries, and they want to have plenty on the inside. So I think that's, and they're negotiating with the IMF or avoiding negotiating with the IMF if they possibly can about a restructuring. So I think Argentina is going to need some serious adaptation to be able to sustain investment there. Otherwise, I agree with Francisco's list.
Jorge, your thoughts?
No, I agree with the colleagues. I think that compared to the rest of the Latin America, Brazil is in a good way. Probably the worst you mentioned you're not going to talk about, but Venezuela, unfortunately, is the one that's going to. Well, they're struggling very much so, and now I don't know even what they're going to survive. So the situation is not looking good for anyone. Okay, but of course the intensity and the form of the impact we are going to vary from country to country. And
Sarah?
If Venezuela is in its own category, I would put the next category as Ecuador.
Got it.
And let me just pick up on this is a discussion about Brazil and Mexico, but with about 5 minutes left, we'd be remiss if we didn't discuss a little bit about Venezuela. Francisco, without getting into could be a whole separate 1 hour discussion on the politics and sanctions and frankly the indictments from last week, the announcement from Secretary Pompeo today, but without going into all the domestic situation, oil output, of course, has declined dramatically in Venezuela over the last 20 years. I think we're about 500,000 or so barrels per day. The price makes it such that it doesn't even kind of after you add in the royalties and the shipping costs, it's negligible what kind of price actually the actual barrel price in Venezuelan crude. What do you see as the greatest effect of this external shock on Venezuela's oil sector?
Venezuela, as was said, is in a separate category. I mean, and this is a perfect storm within a country that already had, a decline of 2/3 of its economy and a collapse of the oil industry. Before the U.S. sanctions, Venezuela produced 1.3. Now it produces, as you said, between 500 and 600,000 barrels, and they have a significant difficulty selling their oil. A combination of sanctions that generates discounts with the low prices. I mean, if Maya is at 9, imagine how much Venezuela will fare for their oil. So it is a very, very, very tough situation. What they don't have too much space for additional inventory. They are exporting more oil to Cuba because, if they rather send it to Cuba than shut it in. But I think eventually, as we have been seeing in the last month or so, the decline that you referred from about 750 to about 550 or something like that. That's what ultimately they would have to do, and there is no nothing in the future except for an economic transition and a recovery of the oil markets that points to anything else than a continued decline in the Venezuelan oil sector. It's a very bad situation.
And even in that scenario, the oil sector couldn't quickly recover, right? It would take many years for the sector to recover to the place in which it once was 20 years ago.
Definitely. I mean, you could, because there is some spare infrastructure, there might be some, initial gains in the short run of the production that is shut in. But you will need, more than $100 billion of investment in Venezuela for a decade to recover the oil industry to what it was, if it ever happens,
So we have time for one more question, pivoting to something that a number of different people have asked in the chat, which is what does does the oil price crash, coronavirus crisis, the crazy world we're living in now mean for renewables and the energy transition in Brazil, Mexico, and perhaps the broader region? This is something, David Goldwyn, I know you've thought about, and I'd love to hear the opinions of others as well, but let's start with David.
Sure. Well, a couple of thoughts. I mean, first, when demand recovers, these low prices for gas in particular, and the low cost for renewables will lower the cost of decarbonization for countries that want to fulfill their commitments. I'm thinking primarily about the Caribbean, which we haven't talked about, but the cost of decarbonizing there and getting away from the volatility of oil and gas prices will be tremendous once tourism recovers. So I think the opportunities are great. I think it'll be a chance for countries to reduce subsidies right now because the cost of reducing subsidies is invisible. And then when the economy recovers and you have liberalized prices for oil and gas and other hydrocarbons, that's going to create a framework which enables renewables to be, and efficiency measures generally, to be more competitive because you'll have realistic cost pricing. So I think the opportunities are there, but this is where, just to plug our strategy a little bit, the real opportunity for countries in the hemisphere coming out of this crisis is to be more competitive. China is not coming to the rescue with more money to lend them to bring them out of this. And so creating the right framework, making themselves more attractive than other places, leveraging that political stability and leveraging the energy transition could be a real comparative advantage. But it's going to take adaptation, and that's where maybe a better regional energy strategy for the hemisphere can help. But I think the opportunities are there, and I don't think the fact that oil is cheap and gas is cheap is going to really set countries off. May delay, but it's not going to set countries off their commitments to the energy transition.
Got it. Anybody else want to have a last word on this? No thoughts.
Let me ask one final quick question to everybody. 30-second answer then, with 2 minutes remaining. What is one thing that we haven't discussed over the course of the last hour that the 200 plus attendees who have joined us today should be thinking about over the course of the next few months? Quick 30-second round robin answer. We'll start with you, Sarah.
I think Latin America is going to present North America with some humanitarian crisis. It's not going to get better in some of these countries.
Jorge.
I agree with Sarah. It would be tough, but looking for the positive side, I believe at the end of this crisis, as usual, we learn during crisis and we forget between crises. Nah? I think at the end of the day, those that are going to survive, the industry will be more, let's say, efficient and more diversified, at least in Brazil.
I'm talking more about the countries than the industry, but yeah.
Thank you. Francisco.
Pretty concerned about the political consequences that this crisis might have. You know, the countries in the region survived well the financial crisis comparatively because, you know, commodity prices recovered because China recovered. But now they are all already in crisis, all with most presidents are unpopular already. And they're facing really tough decisions. And now this coming on top of that, you know, last year was a pretty you know, conflictive year for Latin America. And so I'm pretty concerned about the legacy of instability that this could have in many countries in the region.
Mm-hmm. And as you say, we don't have the commodity boom of the early 2000s necessarily to rely upon. David, last word to you.
Caribbean and Central America. I think the Caribbean economies are being crushed by the absence of tourism. Jamaica isn't even taking any more flights. 3 months without people for hotels, nobody coming for the summer. So these are of strategic importance to the United States, the fate of those economies, for Central America for migration. And so you know, they're both having an energy crisis, but they're just plain old having a crisis. And the old competition between the US and Venezuela for the loyalty to the Caribbean was who's there to help you when the chips are down. And Venezuela was there before. And the question now is, will the United States be there for the Caribbean? So I think it's a bit forgotten right now, and it deserves more priority.
Well, stay tuned. To the Atlantic Council Agent Arts Latin America Center will be continuing to follow very closely, providing analysis, understanding of the broader effects in the energy sector and beyond of the coronavirus crisis and the multiple implication scenarios looking forward over the course of the weeks and months ahead. And thank you all for joining. Randy, I'll turn over to you for a last comment as well.
Thanks, Jason, and thanks to the panelists, and thank you all 200 plus people who joined virtually today. The Global Energy Center of the Atlantic Council will continue to cover the energy impacts of the coronavirus crisis. So please follow us as well, and follow the Atlantic Council as a whole for coverage ranging from economics to misinformation to various regional impacts of the coronavirus crisis. Thank you all, and again, we hope that you, wherever you are healthy and safe today. Have a good afternoon.
Have a good night.